You're watching and observing. You're waiting for the still waters to be disturbed. Watch the water turn red, and then look where is it smooth. I gave you both sides of the marketplace. That means you're looking at both ends of the session, because session draw on liquidity, session liquidity is above and below. All you have to do is wait. Wait for them to do the damage. What's the time window? You're going to see it at 10 o'clock. That means you have to wait that first 30 minutes. Why? Because that is the opening range. That's that vertical line right here. Okay. So when you're watching price action, you're looking all through that first 30 minutes. Your eye is going to where is the initial legs of liquidity. We gave them to you. Here is the buy side, and the sell side was over here, here, and here. And how far could it reach down, Michael? Remember I was telling you that? It can trade down to that new day opening gap. It can trade down into that. And if it's going to trade through that, we have that low over here. Once it does that, it rallies back up to opening range gap, closes it in, drops one more time, overlaps into all this, the rejection block. You heard me talk about that as it's happening. Come back down, hits the new day opening gap from the 16th, rallies back up in. Look how the bodies are staying here. Remember I was saying, listen to this part, okay? It's spending too much time. It's spending too much time inside of the opening range gap. Meaning what? They're not in a hurry to pierce this high, much more meaningful than they did here. So this high and this high still relatively clean. That's just tiny. It's little. That's a little bit of movement. When the algorithm is trading just outside of the lines, it's okay. It's doing everything it's designed to do. To get that price high booked, it's got to go above it because there's a spread. Well, that's all it did there. Did it close above it? No. Did it have much more meaningful movement beyond that? No. Did it trade to the high of the new week opening gap for August 18th, this week's new week opening gap? No. So what is it leaving? It's leaving this liquidity and making these individuals over here feel safe. So what is it going to inspire if it sells off? Shorts to do what? Place their stop loss above here, or if they have deeper pockets, build it right there. So this is engineering liquidity. It drops here. I said, take your attention over here to these wicks, here and here. We watched it drop down below it, took out that low. And now I said, now watch. What I want to see is, does it get back above the new day opening gap on the 16th? And then does it come back down and touch that there? Yes. I don't want to see it trade down and below that wick's consequent encroachment. It never did it. Right there, that tells me, if you go back and listen to what I was talking about, if you're brand new, you don't know what you're doing, you don't worry about this. You don't worry about this. You wait for 7 o'clock and you look for relative equal highs and relative equal lows. Well, guess what? That's this, folks. That's the relative equal highs after 7 o'clock, right here. It rallies. We're waiting. 9:30 opening bell, all the way to 7 o'clock. You're going to look back through that. So if you're going to not be an early trader, you're not trying to trade early. You're going to start looking at the market at 9 o'clock, go back to 7 o'clock. So you're looking back through the last 2 hours. You only have to look back for the last 2 hours to see where the liquidity is. So here at 9 o'clock, what do you have? High that's lower than that. Isn't that a relative equal high? Yes. What are these? Relative equal lows. So what is it doing first? It runs above these highs there, and then creates what? Another smooth relative equal high. But then what does it then do after that? It breaks lower, takes out the liquidity here, and we're watching the opening range. What's it doing? It's finding responsiveness at the midpoint. It has no ability to get to the upper half of it. So what's it going to do? Go back further to 7 o'clock. Anyone that has more advanced understanding, I have students that will be able to use the information that is in price action prior to 7 o'clock in the morning, because they know all the things that I taught them around London and how they deal with the opening and closing of a daily range, power 3. But anything prior to 7 o'clock, well, what does that take you back to here? There, which is what I referred you to when we were, entering into that 9:30 opening. Where's the liquidity at? Here and here. And what did the market do? It addressed what side first? Here. After 9:30. That's here, right there. So did it go for that liquidity or the sell side over here? Which side did it go for? It went for the sell side first. Came back up. Did it take that liquidity out yet when it was here? No. Did it take it out right here? No. So where'd it go? It went below one more time here. We were looking for it to sweep down to here. Then as it was dropping down, I said, watch these wicks in here. It overshot the entire low. That's fine. We're not in a trade. We're observing and watching. What are we waiting for? We want to see it take that low out. Drops. What is this forming? Relative equal lows for anybody that's trading to 9 o'clock. Going in, waiting for what? the first 30 minutes opening range. High, high, relative equal highs. In an area I told you this is going to be problematic. We need to study this. It's going to need to get through this little area here because there's two indecisive candles. Even though that this candlestick's closed and this candlestick's open, is basically symmetrical. It's close. It doesn't really provide a gap. When I see candles like this in the middle, two of them like that, that to me is something that needs to be repriced to. And if it goes through it in the direction I'm looking for it to move, then I'm fine with it. Then I'm going to disregard it and never worry about it again. But go back and listen to it while we were trading here. I said it needs to go through here. And it couldn't do it. Went lower, lower, rallied one more time. The body's staying inside the opening range gap. Just bumped that high and then took us down to clear this. I told you once it done this, I want to see it trade above the new day opening gap on the 16th. Come back down, touch that, and it did. And then I gave you, because of all the things I just outlined, which side did it work predominantly? The sell side. What is the side of the marketplace usually offered to the public first? The wrong side. In the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going, I want to get on board, and they chase it. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you as a student. Okay, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry, Joe, and we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still unfilled? Of course it is. That's exactly what you want to see as a signature. That is the algorithm tipping its hand to me because I know what the fuck I'm looking for. When it does that, it's going to be what I want to see. We want to see it rally up. Where is it going to rally to, Michael? New week opening gap low. And then we want to see it trade into the midpoint of that consequent encroachment. And does it touch the top of it? Look at the bodies respecting it again. Yeah, we wicked through it. And admittedly, when I said 6, yeah, boom, it happened. I thought because it flashed real quick, my eye was watching that. This line, I thought that was this over here. And it had to dig down. And I told you, okay, I want to see it go down into this area here. And there's a balanced price range in there. So it can do that and then send it higher. But these things that will repeat over and over again in price action. The logic of waiting for the sell side and the buy side, once you define what they are, just wait for the first one to get taken. When that water is disturbed and you see violence, jagged, 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 the whole time, these are smooth and this is smooth. Oh, I want to be able to buy down here. Well, when it goes below that, you buy it then. Learn from that. Sometimes it'll be great. Sometimes it won't be. We want to see it trade above the new day opening gap. That means I'm saying that once it gets above that and it starts to trade here, as long as we don't breach that midpoint of that wick right there. Why? Because we've had the stops run below that low in here. So this movement is what? It's a wick on a higher time frame. It just doesn't look like one. It's wicking here to take us below that low and that low. So this low is the low that forms what? These relative equal lows. And it's also being respective of the new day opening gap. See the bodies? Is this one doing it? No. Oh, see, that's logic. I'm not going to refer to this one as we go back above it as support. I'm going to use this one because this one here is already showing that it's done what? It's respected it. So the algorithm is going to go back to that one. It's not going to refer to this one. Which one was on the new day opening gap and the bodies are showing it right there. So now my attention was focused there. We went above it. I want to see it trade down, touch the opening. I'm sorry, the new day opening gap high, and it can trade as low as that low one, but we don't want to see it close below that wick of that candlestick's midpoint or consequent encroachment of it. And it only gave us a touch of the high of the new day opening gap, rallied, showed displacement. Wonderful. Next candle as it's forming, this is going to be a fair value gap. Called before it formed. Institutional order flow, called before it delivered. It did not close in that gap, which is exactly what I told you That's ideal. And then it's off to the races. Wait for the first one to be taken. And then the second one will come later, because the first one shall later be last. That's in scripture. That's the same thing you're seeing in the marketplace. This liquidity was saved. And what you're going to learn, if this is going to be taken second, that means it's going to potentially move a little bit more beyond this one. Meaning what? If you know that a daily range, I said, think of this as a individual bar for a daily chart. Okay. So in other words, it's representing the highest high and the lowest low of the day. Okay. So this is the open. This is the lowest it made for the day, and this is the highest it made for the day, and this is where it stops trading. Okay. If your thinking is that we're probably going to move up over a series of days, or for the week, or for the month, or we're moving in that direction higher, and you're watching price action at 9:30 here, and you've defined the sell side was here. We incorporated that old new day opening gap, and we gave you the buy side. So if we're opening right here at that candlestick's tick opening, we opened, went up, closed down. That opening right there represents this. And then from that opening price, that movement from here to that low would represent that low on the daily open, high, low, close bar. So what we're saying is the open and the initial drop down, that's the fake move. That's the Judas swing. That's where smart money buys. Okay. Now, the complication comes in at where you are going to be a buyer. That opening price here down to that low, in that area, that range, that means where this low forms and where the opening is, you're hunting. You don't have to have the low tick. You're just hunting something to be long. But this opening price down to that low, that range, okay, graphically looks like this. That little sweet spot right here, inside that range, that's where your best opportunity to buy and hold, and just wait until we get to the lunch hour and then measure out where it can retrace. So if there's going to be a lunch macro, if it's going to go lower, you can determine where it's going to go lower and not place your stop loss within grasp of that. Ideally, what you want to do is learn to try to enter when you're bullish longer term, when you think it's going to go higher. So don't think that this is a one-trick pony, intraday trading only, and you can never use it to make bigger money. You can, but you can't appreciate this type of daily candlestick close until you first learn how to read these intraday price fluctuations. But for those individuals that know that this is what it looks like, not every classic buy day or classic sell day, where it's just one direction, that's not the same. A classic buy day is just, it moves up and closes up high. It doesn't mean it's one direction with no retracements. There's sometimes it's like that, and if you're able to hold on to it, they're very, very fun. And I'm teaching you how to do those types of things right here, right now. So if we know the opening price, that's a finite number. They're not going to move that around. It's right there. It's the opening tick on that candle. Then simply wait for it to drop. Aim for liquidity or aim for any inefficiency below that price to the left over here. Okay. The first stage is where the sell side liquidity and then that new day opening gap. It pierced through both of them. And then what did it do? It came right back to opening range. And then I said I was spending too much time into it here. And then it drops, takes out that low. Then I took your attention to that wick, the midpoint of that, and we want to see it get above it. Treat the old new day opening gap. Taking your attention right there, it's going to form a fair value gap. And it's going to be an entry that's an institutional order flow entry drill. That means it's not going to close the gap in. It's going to leave a portion open, and then it fucking does it. What's occurring? This fair value gap with the institutional order flow entry drill and leaving that gap open, where's that forming in the context of the daily range based on this logic over here? It's inside that open to the low. Open to the low. So if you're bullish longer term, and you think that this is the criteria that the daily candles are going to form, or the day that you're trading is going to form this. So this is basically like 5 o'clock or 4:15 Eastern Standard Time, that closing price. In relationship to where you opened up at 9:30 down here, that's bullish, isn't it? So how can you hold on to those trades without having a whole lot of fear, anxiety, or I'm scared I'm going to get stopped out? You have to determine how to buy at the open or below it, because rarely will it go back down after it runs up here. It rarely goes back down there. If it does, it's probably not going to create this condition here. So then the next graduated step is holding through lunch. Aim for 1:30. Close your trade entirely at 1:30. If you're in profit, close it. And you keep doing that. And then eventually what you'll do is you'll watch and see that eventually you'll start seeing the days that do these types of things, they close near their high, but just off the high, like it does here. And you'll see that during the last hour, it creates that far extreme high. And then right before close, it comes off that. And that closes just a little bit below where the highest high was for the day.